At some point, if you haven't done so already, you're probably going to buy a house. And if you're going to buy a house, unless you have hundreds of thousands of dollars cash, you're probably going to need a mortgage. And if you're going to get a mortgage, you're going to need to build your credit. One of the most important, if not the most important things that lenders look for when you go to apply for a mortgage is your credit score, your credit portfolio, and just how you manage your debt. Today, I'm going to give you a couple credit card tips that can help you raise your credit score. So when you're ready to buy that house next year, a couple years from now, whatever your timeline is, you'll be able to get approved, and not only get approved, but also get approved for more and have a lower interest rate. So before I get into any of the tips, I want to talk to you about the 5 factors that determine how your credit score is determined. So first thing first, 35% goes to your on-time payment. That's the largest factor that determines your credit score. That's how it's calculated. 35% on-time payments. Number two, 30% goes to your credit utilization. So how much of your overall credit limit are you spending? That makes up 30%. 15% of your credit score calculation is made up of your age of your credit account. So how long you've actually had credit. Number 4 is 10%. And that's the types of credit that you have. So whether it be a student loan, credit cards, mortgage, whatever. And then number 5 is 10%, which is your hard inquiry. So every time you apply for credit, you get a hard inquiry. I can't say that, on your account. So when you go to buy a car, they run your credit. When you go to get a mortgage, they run your credit. When you get a credit card, they run your credit. All these things show up as hard inquiries on your credit report, and those hard inquiries make up 10% of how your credit score is calculated. Today, we're going to be talking about the first two, which if you remember, if you don't, it's okay. It's on-time payments, which is 35%, and your credit utilization, which is 30%. All right, so if you're someone who is trying to build credit for the first time or is just looking to rebuild your credit and make it better, one of the things I suggest you do is get a secure credit card. The good thing about a secure credit card is it's not unlimited, so it has confines. They're always backed by a cash deposit that you actually make up front. So again, this is you making that initial investment into yourself and ultimately into your financial future. The deposit is usually the same as your credit amount. Most cards, they have a minimum deposit of $200, and that will end up being your credit limit. So I suggest you get a secure credit card. And as you know, I'm not just going to give you information without giving you a resource. The one I suggest you get is the Discover It Cashback Rewards Card. The dope thing about it is it's a secure credit card. It's a cashback card, which is pretty rare for secure credit cards and beginner credit cards. So what that means is simply it gives you money on when you make purchases. So it might be 1% on gas, 2% on restaurants, 1% on groceries, which a lot of the bigger unsecured credit cards offer you, but you won't find in the beginner credit card market. Another dope thing about the Discover It Cashback Rewards Card is it doesn't have an annual fee. Most credit cards have an annual fee you have to pay every year. This card does not, so you can literally keep it forever and never have to pay for it. Of course, you might have to make like a couple of dollar purchases here and there just to keep it active. But again, it's not costing you any money to have this account. And when we talked about the age of credit, if you have this account now and years down the line, you still have it because you don't have to pay for it, this is something that is very beneficial. And the cool thing about this card as well is and most secure credit cards, this one in particular, is when you show a habit of paying your bill on time, they'll actually refund you the deposit and they'll raise your limit. So, I highly suggest this card. It's something that I've used, or I currently have right now, and I've been using it for a few years now. And like I said, I still have it. So once you jump into the world of having credit accounts and having a credit card, the most important thing that you have to make sure you do no matter what is pay your bill on time. And I even suggest paying your bill on time in full, but more importantly, paying it on time. Every time it's due, pay it on time. So how do you do this? Number one, you have to know when your bill is due. You have to be responsible and get that information from the beginning, whether you write it down on a calendar, put it in your phone, whatever. You have to know when that bill is due because you need to make sure you pay your bill on time. Keep the goal in mind. Keep it very clear. You're trying to build your credit because you want to buy a house at some point. So you need to make sure you're doing the most important thing when it comes to building credit, which is paying your bill on time. Even one late payment can actually drop your credit score drastically. So you just want to make sure you're doing what's necessary to pay that bill when it is due, not after it's due, and ideally even before it's due, which we'll talk about in a little bit. But like I said, most important thing, pay your bill on time. Now, when we talk about your utilization rate, the goal is to keep your utilization rate under 30%. Now, what does that mean? At some point during your credit billing cycle, your statement will close. And when your statement closes, so they're going to take a snapshot and they're going to look at how much of your credit limit did you use. The ideal number is less than 30%. For me, it should be 10% or less. That's just the way I operate. But everything that I've read, all the research that I've done for years, they say 30% or less. And again, for me, I say 10% just because it looks better on paper. Using too much of your available credit is the biggest red flag when it comes to your credit score. They're going to look at you as a risky lender because they see that you're always relying on your credit, and that just doesn't bode well if you're trying to build your credit. But transversely, if you are someone who doesn't use much of their credit at all every time your statement closes and they see that, then they will look at you as somebody who is who's responsible with their credit, responsible with their debt, because this is what credit is. So like no matter what your credit limit is, whether it's $200, $2,000, $2 million, best practice is to keep that utilization rate under 30%. But like I said, for me, it's better to keep it 10% or less. Now, I just talked to you about your statement closing, and outside of knowing when your bill is due, you really want to make sure you know when that statement closes, because this next tip revolves solely around that date. So let's say your bill is due on the 15th of each month. Your statement will always close a few days before that. So let's say in this case, it's the 10th, right? You should be paying your balance down to under that 30% before your statement closes. Here's why. When you pay your credit card balance before the statement closes, you're going to lower your interest payment. You're going to lower how much your bill is, and you're always going to increase your credit score, because when you pay it early, especially in full, you're lowering your utilization rate. Now, even better, when I talk about paying it under 10% and even best case scenario 0%, when you pay it off completely before your statement even closes, before they even see that you used your credit, you're never going to get charged anything, ever. You're never going to get charged interest. You're never going to have a bill to pay because you already paid it before they saw that you used it. So even if there's a zero balance being reported to the credit bureaus at the end of each billing cycle, your on-time payment history is good because there's no balance to pay. And the length of your account history will continue to work in your favor because you're actively using that account and you're building the score. They're just not seeing how much of your credit that you're using. Now, I have to tell you, this is for somebody who is more disciplined and responsible, but I do this, and I'm telling you, it works, and it works quickly. Now, with that last tip, paying your balance down before your statement closes, that's only going to work if you are somebody who has this type of mindset to where you know exactly how much money you have to work with, which means if you watch my last video, you heard the last episode, you know that you have to be on a budget to see exactly where you line up each month financially. You know that this is the way you should think. If you can't buy it twice, you can't afford it to pay for it with credit. If you can't buy it twice, don't buy it with credit. You can't afford it. This is what I mean. All of your credit card purchases should be backed in cash. If you have to spend $100 on something and you want to do it with your credit card, you need to have $100 in cash ready to pay that bill off in full when you get it, because it's coming. If you have to spend $500 on something, make sure you have $500 in cash or in your checking account ready to go to pay that balance down before your statement closes, because again, it's coming. Make sure you have the money to pay the bill on time and in full when the bill comes. Listen, this is something that, like I said, it's a mindset thing. If you want to build your credit and you know why you're trying to build your credit, and keeping your goal in mind to be able to purchase a home with a lower interest rate, with a higher approval rating and a higher overall approval amount from your lender, this is the one tip that will keep you on track. Look, you already are on a budget, so you know how much money you have to work with. If you have a credit limit that you can work with, then you know you have the money to spend. And when you use your credit card wisely, this will get you closer to that goal. But like I said, if you can't buy it twice, meaning you don't have the cash to line up with the credit card purchase, you can't afford it. So these are just some of the tips that I think are necessary to talk about when we're trying to build our credit and get ourselves in a better position financially, whether it be to buy a house or just show up better on paper. These are some of the tips that you can look at and you can implement today to put yourself in a better position financially, and ultimately in the future, when you look back and you say, "Man, I'm glad I got my credit score up. I'm glad I got that budget." These are the moments right now where we can impact our future. So I hope you enjoyed this episode, and we'll see you next time.